Our next guest doesn't see many positives in the overall markets. His firm is very bearish, thanks mainly to the EU and China. Tim Strazzini helps to oversee $1 billion in assets as head of trading at Dialectic Capital Management. Now, Tim, last time you were here, you said you were very concerned about China, very concerned about Europe. So besides looking at me right now and saying, I told you so, I told you so, why don't you give us your current views on both China and Europe?
Yeah, I mean, the data continues to support our thesis. In Asia, we're really reflecting our view most strongly in the property sector. So you're excuse me, you're continuing to see, as far as new home prices, you're continuing to see the trend of those lagging. We're continuing to see, as far as the overall number of cities polled in terms of the National Bureau of Statistics, polls about 70 cities in China. You're continuing to see that number grow in terms of the number of cities that have a decreasing number of sales at a lower price. So the data continues to support our thesis. We're in almost every property developer from the short side at this point to reflect that view, but concentrated in like Evergrande, Sinoland, Country Garden, some of the larger Hong Kong property names.
What about all the talk, though, that the Chinese might lower reserve ratio requirements for their banks? Is that
they're definitely not going to go down?
Stabilize?
They're definitely not going to go down without a fight. I mean, one of the things that we're looking at to continue to give us conviction here is how they really never contracted as it pertained to overall loan growth in 2011. So at this point, yes, they are very keenly aware of their issue of inventory and decreasing sales and social stabilization and how everything's become kind of intertwined on the real estate side, just like it did in the U.S. But I would argue that they're running out of bullets here. They really can't continue to grow loans, to make mortgages easier, and say that they're able to just highlight first-time home buyers. So they will continue to cut the reserve requirement. They will lower mortgages for first-time home buyers. They'll do other stimulative things, but they're running out of things to do to continue to provide liquidity or reflate real estate, which is something that the U.S. really fought with in 2009.
Last gasps.
How about the PMI number out of China? We know it wasn't good for overall Chinese consumption, but what does it mean for Europe? Europe is dependent on their exports to China. Is this bad news for them?
So I never felt that it was an out of consensus view to say that Europe was going to be in a recession in 2012. But given the market action in the first quarter, it really seemed like it. Look, Germany is going to be holding on very thinly to some small positive gain economically, GDP. The rest of the continent is going through austerity measures. So Europe is its own steaming pile right now. And a lot of that is because of China, and that's only going to get worse. But a big part of it is just their natural kind of interplay EU. Every country is slowing down, going through austerity measures. We've chosen to reflect that mostly in the transportation sector, just kind of pure economic cycle. So, yes, the luxury good consumer and the high-end stuff is also acting poorly. But the data we're seeing in, like, Class 8 trucks, excessive inventory, so Volvo, PACCAR, Navistar, names here in the U.S., you're continuing to see slowdowns there. I think in February, globally, the managers on the truck side were just way too rosy in terms of the picture, and now we're starting to see really slowing data. I mean, those charts look horrible in those.
Now, can you speak about these multi-level marketers? This is a space we don't hear of much, but I know you don't like.
Wait, what are multi-level marketers?
Sure. Well, first, as a sector, just in this brief discussion here, everything we're talking about is so macro interlaced these days. Here's a sector that is not macro interlaced at all. So a multi-level marketer in kind of the traditional sense dates back to like an Amway from the 60s, right? I bring you on board, you buy inventory, you sell it to your friends, I make a VIG, and you manage that. It's kind of a classic pyramid scheme, which carries some of the negative connotation. Amway's been able to keep it alive without all the negative connotation. A lot of that is from a lot of contributions to the Republican Party. So the pure play multi-level marketers these days aren't quite as polished and institutionalized as Amway. There's names like Nu Skin, Herbalife, Blythe, which used to sell candles, now sells protein shakes to people in California. So there are classic names out there where the growth looks exponential. So sell-side analysts,
have been doing very well, too.
Yeah, they tend to have a very specific life cycle, right? The analysts model them. The growth is astronomical. The churn rates of these companies tend to be the high-intensity salespeople move from company to company. They bring in their friends. Pretty soon you have 10,000 people selling it. The churn rates are like 60, 70%. When these pyramids get large enough, a churn rate of 60% at the bottom rung tends to make things fall apart.
Make sure you're not at the bottom rung.
Exactly.
All right, that's the key.